So hello and good afternoon. I welcome you to today's special webinar. Today on Thursday, one second. Very good. Okay, Thursday, the 22nd of March 2018. So initially, you just saw that I already prepared a chart which I want to present to you here based on the decision of the Fed yesterday to hike rates. And in fact, the thing is that let's say I'm not surprised to see the current price action in European markets. I mentioned this during the morning meeting already today. I mentioned it in the morning already in my technical piece, only available in German, but nevertheless. And so to be honest, I'm happy to see that currently because in fact I have a short position in the DAX, and I just hope that this trend will continue now. On the downside. Nevertheless, before we start, first of all, let's have a look here at the risk disclaimer. Yeah, so it's not that surprising because, in fact, when carefully looking at the decision from the Fed yesterday, the statement itself, I think it becomes quite clear that after what we've seen here, especially from Jay Powell, the new Fed chairman, what he talked about in front of the U.S. Congress. And while I'm talking here, let me already give you this chart here, and you can take a screenshot to just have the setup then available. But let's come back to the Fed first. So the decision of the Fed, in fact, can be considered, I think, a so-called dovish hike, because there was, after the first appearance of Jay Powell in front of the U.S. Congress 1 month ago, there was some serious belief in the market, I think, or at least speculation building that there's a good chance that the Fed could hike rates 4 times in 2018. And when looking at the dot plot here, which is showing how several Fed officials position themselves in terms of the expectation of the rate level here. In this case, 2018, you can see this here. This 2019. What you can see is that there is only 3 hikes from those Fed officials expected, and this is probably the main reason, especially why gold, for example, pushed aggressively higher yesterday. So this is the DAX, by the way. We'll have a look at the DAX a little later, and then also the US equity markets. So here, this bullish reaction in gold is not such a big surprise. It's gold daily. We are still choppy, in fact. So if you ask me what to expect from gold here, I'd say, well, rather sooner or later, I think there will be a serious attempt to break back above the current highs here from March, which can be found around 1,340 to 341. And if we make it above that level, there's the next target to be found at 360, 365. And in fact, we're now really zooming out of the chart and stepping back. What you can that's not so good. Okay, the problem is I don't have enough history here. But what you can also already see here, at least, is that the market is obviously finding some strong resistance here on the upside. And the interesting thing is that based on that, there is a wedge forming in gold. So what you can see here is that the pressure, which comes from the region around 1,360, 365, 1 second, is diminishing more and more. Why do I say that perspective? Why can we see that? Well, you can see here first aggressive attempt on the downside, and then there's another attack where the highs from 2017 was a push lower, yes, but nevertheless it was way shorter, this push lower, and now there's again attack at this level, but nevertheless the market is pushing, and again significantly higher in this case than the first attempt here, respectively the second. And this is showing that the supply coming in from the upside is diminishing more and more, and chances are increasing that there will be an attempt to break this region. And if we break it, I think then there is some significant room building, by the way, it's not the daily chart anymore, but it's the weekly chart now. And I think from this, we have a chance to probably push at least up to 1,600, 1,700 USD per ounce. So we're not talking about a day or so, but we're definitely talking about a midterm target, let's say, and especially when there is some serious concerns building now that the US is probably about to enter a recession rather sooner than later. Because, and this is the thing, if you carefully watch at this dot plot, then the thing is that if we only can expect 3 hikes in 2018, the question is why? And I think there's serious concerns also within, or here between several Fed officials, that the US economy can probably see some more significant pullback here, probably induced by those discussions around tariffs, let's say, respectively, protectionism from the White House under those Trump administration. And in combination, I think hiking rates plus such a protectionism outlook, or protective outlook, let's call it. This is a combination which is not very positive for the overall economy. And this could backfire not only in the US, but also, for example, worldwide and globally, especially as if many countries enter such a trade war, not just China, but also probably the Eurozone. And all this, if you combine this, it's not a very, very good outlook then here, what to expect for the future economy. Based on that, if you interpret this dot plot that way, the reaction in equity markets is not coming as such a big surprise to me, because it's underlining that there are serious concerns about the U.S. economy, and this is something which weighs more heavily on the equity markets right now. And one good reason to see in this case then European markets, probably also U.S. equity markets, let's just see, but perform quite good on the downside today, instead of the upside. And if you carefully watch, I mean, yesterday, in fact, there was nothing big to be expected today, in fact, because we still traded within a trading range between 12,130. This is the low from last week, and here the high around 12,470 to 12,500 points. And now the thing is that yesterday, after the first dovish interpretation of this hike here, the small spike on the upside, the market then just set back and saw some serious selling pressure building. And the thing here is that based on this price action, there were serious signs that it probably could continue. We started out quite bearish today, yes, but nevertheless made it back. I was a little skeptical here after the spot market index opened, but after the market then fell back to these daily lows again, I started to be quite optimistic. In fact, having already a short position here, that there is another attempt on the downside. And now the question is, will this continue or not? I have to say, if you look at the Dow Jones right now, for example, and we are currently in the pre-market phase here, so the market is about to open in 20 minutes. We have already attacked and fallen below the current weekly lows. If this pressure continues, it could get a serious attempt here on the downside to attack the region around 24,200 points. And this then could lead to further losses in the upcoming hours then. So that said, I consider short engagement to be favorable of over long engagements, in fact. And let's just see if it works out or not. Before we continue, in fact, I'd like to make an announcement. There will be a special webinar tonight here at JFD Brokers, and it's about professional trading, the JFD Basket Investor. So some of you might have wondered what I'm talking about when I'm saying I'm short the DAX right now. So I'm trading, or also managing. I'm the manager of this manager/trader of this portfolio here. It's a managed account. I'm managing together here with Stefan Friedrichowski. Some of you might know him. Last year, in June, July, we had a webinar together here on FX Street, a webinar series, in fact, and showing some strategies and how to how to build a profitable trading strategy, and what it means to trade such an approach. And tonight here at this webinar, by the way, in the chat box on YouTube, you can find the registration link here. It's completely for free. It's not just looking at two strategies here. In fact, one on the DAX and the other on, especially interesting probably for FX traders, on the Euro Japanese yen. But on top of that, we can also, or not we can, but we will send out the ebooks here, PDFs, to all registrants of the webinar. It's two strategies we are trading within this basket. It's not the only strategies we're trading, but nevertheless, so it's no coincidence that JFD stands for Just, Fair, and Direct, and is putting transparency at the top of its business model here. But it's also something that under the licensed umbrella here with this managed account from JFD Brokers, we want to give further transparency and bring this to an even higher level here, and give also interested people, potential investors, to have an idea about which strategies are traded, and not just which strategies are traded, but also send out in PDF here, because it's no big it's no holy grail, or let's say it's a big what's the word for this? I'm missing this. Secret. It's no big secret. Yes. Because the strategies are proven profitable strategies. By the way, also here, even if it's a little adapted strategy, and that's the one I present here today on the S&P in this case. But the S&P, for example, is also traded within this basket based on one open range breakout scenario, one open range breakout setup here. So and again, if you're interested in that, just click the registration link, register for tonight's webinar. It started, by the way, at 6 p.m. GMT, so it's around 5 hours from now. And I'd really appreciate it to welcome you there. If you have any questions, shoot me an email, whatever. Just register for the webinar, and then we'll have a deeper look in those strategies, and also give an idea of how to manage risk from a professional perspective. So here during these webinars, those live trading sessions, I give already an idea of how to manage the risk of one strategy. But now imagine you have a basket of strategies to diversify your portfolio, and then you have to weigh each strategy in a certain way. And some of you probably might now raise their eyebrows and say, hey, this sounds like real professional solutions. Do not hedge funds or investment banks and prop trading desks and that stuff work that way? Exactly, yes. And that's why we called it the professional trading webinar. It's really professional trading, in fact. And by the way, on top of that, it's not only that, but we can also, what I can show you here is something also transparency, the performance of this account so far. So this is the account balance. But this is the overall profit so far, for example. So it's working out really well. Just to give an insight in, again, not just which strategies we are trading here, but also risk parameters, who are the traders. In fact, it's me and Stefan mainly. Also very interesting probably here, if you look at the monthly return table, for example. So currently we're had 2% in the month of March, which is also very astounding results so far. And if today works out well, so far it looks good, then probably we can add another 0.5% or something like that to the overall performance for the month. So please, yeah, feel free to register. I'd really like to welcome you there. And now let's come back to the action here and have a look at this setup and how to trade this setup. Probably then one of these setups here, the one I already presented here. So therefore, first of all, we have to define the open range. In fact, it's not the right time because of summertime right now. So right now it's 1:30 to 2:15 p.m. GMT, so 1 hour earlier. This will change from next week onwards again. And therefore, let's switch over here to the S&P 500. So trading spot open is in around 15 minutes. And in fact, we have 45 minutes to just wait. And we have to wait, and we have to see, and what will happen. So the thing is that here, yesterday, for example, perfectly shows what market conditions you don't want to see, what you definitely don't want to see when trading such a breakout approach. While the day before, not the day before. No, that's not right. On Tuesday also, market action was really suboptimal, let's say, for this approach. But on Monday, then the market was really performing really well in terms of this strategy, because as you can see here, it was a clear, clean trend structure which developed over the hours of intraday trading hours here. And that way, the market really turned out a nice profit. So this, respectively, the market environment yesterday was horrible for the strategy. If the market starts to trend, then we have a very, very good chance to catch most of this, let's call it meat in the middle. So in fact, just to show you how to define the open range. So you look at the first 45 minutes of trading in this case. So in our case here, we have a 50-minute chart. Meaning we look at the first 3 candles, and what you can also see here is it's a little colorful. So I just want to explain to you what are these lines. So first of all, in fact, you don't need this, in fact, because in the MetaTrader, for example, you can work with the so-called breakout indicator, which is automatically showing you where the high and where the low of those 45 minutes is. You can define that. But in fact, I love to have a little more colorful, respectively clearer picture, especially around the trading hours. So what we know is that the S&P 500, for example, is traded 24 hours, 5 days a week. Okay, there are slight interruptions in between with a rollover period between, I think, 9:30. I think, yes, 9:30 till 9:45 p.m. GMT. But all in all, we can say that trading is taking place 24 hours a day in the S&P. Now, the thing is that the main volume, nevertheless, can be found and is traded during Wall Street is open / the spot market is available. And this is from then 2:30 p.m. GMT till, no, it's right. Yeah, 2:30 p.m. GMT till 9 p.m. GMT. And this is what you can see here with those gray lines. So this is the spot trading from yesterday, main trading hours, and this is the main trading hours from today. So you can see here, it's 1:30 p.m. GMT till, in this case, 8 p.m. GMT because of summertime. And then from next week onwards is again 2:30 till 9 p.m. GMT. The green line shows the low from yesterday during those trading hours. The red line is the high during those trading hours. And the deep blue line is the closing price. So in fact, the turquoise line here is something we have to somewhere put here or something. This will be the first tick at, in this case, 1:30 p.m. GMT. So the first tick at which the market opens. And in fact, it's only kind of an orientation, let's say. Yeah. So I know if the market is trading above or below that line with one glance at the chart. So if I look at the chart once, I can see, are we trading above that or below that? Even though it's only an indication, it gives an idea of where the advantage can be found. And so what we do then is, again, we wait for the first 3 candles to show. So let me just make this probably here that way. And then we look at the low, which yesterday was at 15.5. Is this probably here? No, this is the low. And why is that? 1 second. Let me just make this that way. So as you can see here, there's the low of this range. And here is the high that's based on this candle. And so what we're doing, in fact, is we are then saying, if we break out on the upside here, and we are trading above, in this case, this yellow line, which is the exponential moving average 10 on a 50-minute time frame, and this is our trend filter. If we're trading above that and break out on the upside, we're going long. If we trade below that and break out on the short side, we are short. As you can see, obviously, we went long yesterday, since here the market broke out on the upside, even though only a small bit initially, but we traded above this yellow line, and that was the moment when we then decided to enter a long position in this case, placing the stop here below this low of this range. So this is, by the way, exactly what's written down here. So we identify the advantage based on, in this case, the 50-minute exponential moving average 10. Trading above that means we're only going long. Trading below that, we are only going short. And then we trade the break of the open range in direction of this identified advantage. Stop above, respectively below the high low of the range. In the case yesterday, we traded above the exponential moving average 10, broke it on the upside, so we went long. So the stop was placed below the low of the range, which is this line here. So now you might wonder, okay, well, this is great. Look at this. I mean, the breakout occurred, and obviously the market trended heavily in our direction initially. So I mean, that was kind of a strong move. I mean, here that was the high. The market traded 20 points in our direction. The thing is, yesterday turned out a loss. In fact, the market where the trade got stopped out within this candle, because the approach itself says we are not taking any profits within the day, but it's a so-called make or break approach, meaning we're entering the market based on the presented logic, and then we close the trade at, in this case, right now at 8:50 p.m. GMT. That's usually now during the summertime switch, we close it at 7:50 p.m. GMT. So only 1 hour earlier. And that's it, in fact. So now you might wonder, is this really a profitable approach? I mean, it's a very simple approach, right? So if you look at this, this is ridiculous. There's only 3 steps. No one can really imagine that this is a profitable trading approach. Because if you look at the chart of a professional, by the way, this is now ironic, don't get me wrong, please. If you look at the chart of a professional, usually you see many, many lines there, and many colors, and that's one of the reasons. There, somewhere in there must be the indicator which is generating huge amounts of money for the trader trading that way. And so now the thing is that in fact the simplicity of this trading approach is one of the main reasons why this approach is not only easily duplicable. You can easily duplicate it. It's not very difficult. Everyone can trade this, just following those parameters just presented here. The only one missing is the one when you close the trade. But now I told you that it's 10 minutes before the spot market closes, which is currently at 7:50 p.m. GMT, and in 1 week, but also from Monday p.m. GMT. That's it. Okay, so you can easily duplicate this strategy, but no one really believes that this is a profitable approach. And in fact, it is. And that's something I want to show you here. 1 second. Where do I have it? Here. And then I'll show you. This is data from Stefan in this case. So the guy I will hold the webinar tonight with. That was a screenshot I made during, that was a screenshot I made during the webinar we held together here for FX Street. And the reason I took this screenshot was because he had some trouble with his internet connection. And I just thought, the moment he gets lost, I can take over here and I have something to show to the audience. And in fact, I took the screenshot and 30 seconds later, he was gone. He came back, nevertheless, he was gone initially. And then, yeah, so what you can see is if you test this strategy based on these parameters for the last, in this case, 7.5 years here, back towards November 2010, what you can see is that with a hit rate of 47% and an average profit of 1.08 to an average loss of 0.82. So a payoff ratio, we call this, if we put or calculate the ratio based on the average profit and the average loss, we have a payoff ratio of so-called 1.31 to 47%. Now you might think that probably I'm a freak or so. Well, I've showed this chart several times, so and that's the reason why I have this number in my mind all the time. So the average profit through the average loss, it's 1.3 to 1. And with a hit rate of 47%, I mean, even though it's historical data, but nevertheless, it's a very, very long time we tested this, and there's not much room for us to optimize anything. I mean, what we can change, sure, is the open range, and within or during which time we calculate our open range. What we can also do is we can play around a little here with the exponential moving average 10 on a 50-minute time frame. But all in all, you might have seen trading approaches which have plenty of options to somehow optimize some parameters here. And this is, in this case, it's not possible to really do that. But what you could probably test, for example, is I just have to see whether this also works. I haven't, in fact. I looked at this. Okay, 1 second. Let me just see whether this works or not. What happens when I look at this here? Let me just have a look. I'm not sure about this equity curve, by the way. It's okay, never. Yeah, okay, great. I mean, in this case, we only back tested it for 185 days, and in this case, we work with the exponential moving average 50. So we dramatically changed the exponential moving average 50, and we didn't take so many trading days in this back test. And yeah, the reason we did this is only that was one thing which Stefan really likes to do. He usually looks what is the behavior of the strategy if I change such an important number like the exponential moving average. What happens with the trading result if we are still trading within a neighborhood here? So what do I mean by neighborhood? Well, neighborhood means that if you're working with an exponential moving average 10, then the strategy should also work with an exponential moving average 12 and an exponential moving average 8. In case of exponential moving average 50, this is a dramatic change since you're now working with an exponential moving average, which is 5 times as high as you usually trade with it. And even then, the approach seems to be profitable, at least for the last 6 months you're testing this approach here, and with a hit rate here of nearly 50%. But let's come back then here to this chart first. And what you can do now is you can calculate something we call expected value. The expected value is the amount you can expect to make per, in fact, in case of you're trading with the euro account, euros you're risking when you're trading, for example. And so if you calculate this that way, so it's in fact, it's the payoff ratio, it's the average gain, average profit multiplied with the hit rate, and then you subtract the average loss and you multiply it with the loss rate, which is 0.53. And also here, the result all in all is 0.08 euro per euro risk. Now, some of you might say, okay, this is not that good, right? Because you're risking €1. That's not a very good payoff. Well, don't get this number wrong. It's the expected value. It has nothing to do with the payoff ratio. So we already calculated the payoff ratio, and we have seen here that the average profit is higher than the average loss. So this is the number you can expect to earn per euro you're risking, and which means earning it on every trade. It doesn't matter if it's a winning or if it's a losing trade. So that means that here in this case, let's say you're risking €1,000 per trade, you're making, in this case, €80 per trade. If it's a winner or a loser, it doesn't matter. It's pure historical data. Yes, again, that's something to consider. But if you can stabilize those parameters, and if you start to think here, you're in your trading in such terms of expected value and probabilities, and knowing that you're trading with a positive expected value, you won't. And there will be no time in the future again that you start to doubt your abilities of a trader or something. You just trade an approach which has a positive expected value, period. And then you know that you're making money in your trading, and you just go from there. So in fact, one of my approaches is something you might be interested in, because I already mentioned this here in the webinar tonight. 1 second again. Let me just show you here this account again, respectively here, the registration form. Again, you can find it in the chat box. So what is my role in this basket here? Because it's a basket of purely automated trading strategies and discretionary traded strategies. And I'm the discretionary part. So yesterday when we had the German version of this format here, I was I was smiling a little and laughing a little, in fact, because the thing is that discretionary just sounds like you're trading freestyle. You know, it's you have no set of rules, but it's just a gut feeling, and then I just say, okay, rule of thumb. Well, let's go long, let's go short. In fact, I have an opinion of the market. I will just say that. By the way, we just started the trading day here, and we have to adapt this line a little. I have an opinion on the market, and there are days when I just skip, for example, trading. It's not only because I have a different market than the system is telling me, but it's also because market conditions probably do not fit my personality. Like at the beginning of February, when there was huge volatility and really the market thinned out dramatically. So there was huge spikes on one and the other hand. And I have to say that based on my personal experience and on my trading, I know how important liquidity is. So not that I was affected by the crash of the S&P in 2015 in January. Some of you might remember that when the S&P removed the peg at 120 in euro Swiss franc. But I worked for a broker back then, which is which was massively affected by this. The only number I need to say here probably is 300 million, and some of you might exactly know which broker I'm talking about. So I'm not naming this broker right now. They're still alive. Nevertheless, they faced really serious trouble post the S&P and the developments there. And it was mainly a liquidity issue. There was no liquidity below 120. And if you face such a situation, and also on top of that, you've seen order books thinning out around NFPs and all this, you know how important it is to really scale back in your trading, especially in terms of position size, because you can't really calculate where the market will stop if it starts to slip in one or the other direction, squeeze, let's say, in one or the other direction. And so why do I mention that? Well, this is what I can do from a discretionary perspective and what I actively do, in fact. Nevertheless, the thing is that it's a basic strategy which has a positive expected value, and where my experience and my knowledge comes into play, and I try to optimize the strategy. What does this mean? Well, let's have a look here at this number again around the expected value. So the expected value gives me a number I can expect based on the hit rate, respectively on the average profit and the average loss. So what is my target? Well, my target is in fact to make this number slightly bigger, because it means I increase the overall profitability of this, in fact, automated strategy. So it's not a gut feeling or a freestyle decision I take here, but it's like I'm trading with an advantage, a clear defined advantage, and then I try to optimize the expected value, not only on one trade or on 10, but on all trades combined. And this is in fact what I'm what is my role in this trading account, and I'm adding 20 to 30%. I think currently we are at 25%. I have at the overall risk. So for example, we are risking 1% in this account per day. That equals here, if you look at the current account balance of slightly above 400,000 euros, we say we are willing to risk 1% of this overall account each day, even though we are not even close of reaching this number. It's the worst case scenario. It's something we will explain then in the evening then. And from those 4,000 euros in this case, let's make a round number, I am risking 25%, which in this case comes down to 1,000 euros. So the overall risk I'm taking per day is 1,000 euros based on this automated strategy I try to optimize in terms of a expected value. So just to give you an idea how this works and how you can think about this, how such an optimization could work. So again, I already said I'm short the DAX right now. And let me just have a look here. This is beautiful. I mean, this is just awesome to see the market dropping and keeping dropping. Currently, by the way, I moved my stop to break even for the day. And now I start to wonder whether it probably makes sense to probably take at least part of the profits here. currently. Probably that makes sense. Yeah. So just 1 second, please. I just have to do something here. I just show you what I'm just doing here. 1 second, please. Okay. So yeah. So the thing is, I could have done this now, also live here. Nevertheless, I want to try this. The problem is that currently I have some issues here to run the MetaTrader and the webinar parallel to each other. So that's one of the reasons you can see here this small picture, which is in fact the VPS. And there you can see it here. So it's a VPS, and there I have a trading platform. The unfortunate thing is that I can't move here this screen over to the main screen. Yeah, that's a little. But let me just show you here. 1 second. So I know open the MetaTrader. I will close it afterwards again, but just to show you here. So obviously there are several positions open now, and in fact, what you could have seen here a few seconds ago was that the position was 15 contracts short. In fact, I took out 4.6, so half of the position I'm currently trading, yeah. So I just took part of the profits here in this case, and yeah, let's just see. So currently it wasn't a bad decision. Why did I do that? Well, the thing is, and this is something from a discretionary standpoint, for example, the system itself, the basic strategy, what does it do? Well, it just holds the position till the end of the trading day. And it's still profitable. So it works. The basic strategy works. And now, nevertheless, the market has already seen a huge extension on the downside. So just let me give you a better overview of this from a theoretical standpoint. So, and we work with the short side in this case, by the way. So some of you might have heard about something we call Dow theory, or knowledge about market structure, progressions, regressions, and that stuff. So if you have such a sequence here of falling highs and falling lows, you have obviously a downtrend, right? So no question about that. So now, if the market is making a new low, which happened here, we start to enter something we call distribution area. So what do I mean by that? So there's difference between accumulation and distribution, obviously. So what you can see when looking at how professional traders build positions, what they usually do is they build this position in a region where not much liquidity issues occur, let's call it. So what do I mean by that? Well, if the market is retracing here part of this progressive move here, then betting that the market will continue this move on the downside it's very aggressive speculation, and you try to anticipate this break. But why do you try to anticipate it? Well, what you know is that if you look here at this region around the lows, that's, I mean, there are plenty. I'm sorry. There are plenty of ways to analyze the market, right? So, like for example, with head shoulder formations, Gartley patterns, divergences, pivot points, Fibonacci's, and all this. And so you have tons of possibilities to find potential reasons why the market could be long, respectively why the market could be short. And so the interesting thing about this is that even though it might work out for you from a neutral or objective perspective seen, it's very subjective. It's very subjective because I probably do not see this Gartley pattern you might see in your chart, and based on which the market could rise or fall. Now, nevertheless, what we all see, and what's a neutral input here, or what's a complete neutral aspect is former lows, for example, or market opening, market close, or the market close of the day before then, the highs of the day before, weekly highs, weekly lows, monthly highs, monthly lows. So these are numbers you can see within every candle. Okay, so and now the thing about this is that if the market is breaking such a level here, this is a complete and 100% neutral and objective level. It's a formal low the market is breaking here. But what does happen here in this moment? Well, everyone is somehow looking at this level. At least we think that this is happening, that everyone is looking at this level. But based on everyone, let's put this in quotation marks, looking at this level, what does it mean? Well, it means that there will be a natural higher interest of people, probably if they are long for whatever reason, because thinking now the market is making or building a bottom here and now turning around, or the market will move further on the downside. So if you're long, you place a stop here, which is, if you put it simply, it's a sell stop. The same is true for someone getting stopped into the trade here when the market breaks to new lows. It's a sell stop. So there's naturally some selling pressure building here in this moment where the supply overcomes the demand from a natural perspective. So if the market is now breaking here, then the thing is the following, that with the market moving lower, lower, and even lower, from a natural perspective, what you can expect is the following. Let me just see whether this is good work. Let's so. Second, let me do it that way. No, that's not good. Okay, it doesn't matter. So usually you expect, if you say that here is some big seller pressure building, that this selling pressure, if you just think that this is a minus here, yeah, that this selling pressure naturally diminishes. So that means that rather sooner or later, the market is probably about to see a corrective move. That doesn't mean that it will break the down structure, the sequence of falling highs and falling lows. That will be the case if we make it above this level here from a pure definition perspective of a downtrend. But nevertheless, you expect this momentum to diminish more and more the deeper the market falls in this moment. And based on that, and if you are short, so what you aim on is you probably want to make sure to take at least part of the gains you acquired so far to make sure that you probably, that you will at least increase the chances the expected value if the market now really starts with such a sequence of then higher highs and higher lows. Because if this really happens, well, you have at least taken part of your gains here, while the rest is probably stopped out at this level, which will result in an overall better outcome of the trade if the moment we are probably closing out the whole position at this point. Obviously, if you close part of the position here and the rest here, you will probably have an average price of this level, and the difference is something where your expected value comes out better than if you closed out the whole position at this point, right? And if you do this over and over again and are capable of optimizing the expected value of the basic strategy that way, well, you're obviously making the strategy, the basic strategy, which is already profitable, even more profitable. And this is exactly why I now decided to take at least part of the profits here. The good thing about this is, nevertheless, I don't know whether this is right now the bottom, let's say. I have no clue. It's just that the market seems to have extended the move on the downside. Look at this structure and compare the structure of falling highs and falling lows, especially this extension here, compared to what I just described in this picture. So if you look at this leg lower here, this is exactly what you can see here. So I think chances increase that we are probably about to see at least a small corrective move. Probably it will bring us to the level around 12,150 points or so. probably we get to see a retest of this exponential moving average 50 in this case. And if this really happens, well, I've had at least take part profits here in this region at those lows, and then probably can put on another position again. Respectively, probably we won't make it to this level anymore. And so I have at least saved half of my position here in this region. So on the other hand, if the market now keeps on falling, obviously, and then something bad will happen, bad, let's put this in quotation marks. Well, the thing is that here, if the market now moves lower from there, let me just try to make this a little clearer. Click, 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 click. Now let's just assume that the market will see a corrective move like the one I just described, and then from there move lower again. That would be bad, because now I've taken part of my profits here in this region. Well, let me put it that way. And the market will probably close somewhere, let's say here, somewhere at these lows. Let's say there's a very, very bearish close of the trading day for whatever reason. So obviously, if I take half of the profits here and the rest here, then with the second half, well, my average price will be somewhere here. And the difference is something where I scored, less good, or there's a minus, let's say. So probably the overall strategy performs 30, 40 points better than I do. Nevertheless, it's only one occasion in this case. So what's the target to optimize the overall expected value of a strategy is to really document in a very detailed way how you performed compared to the basic strategy. And if the overall result after, let's say, 100, 200 trades is better, well, obviously, thanks to your knowledge and thanks to your input, you made the strategy, put in quotation marks, better, or you made it more profitable. And that way, and this is the interesting thing, and this is where professional thinking, professional trading comes into play. Well, at least, I mean, yes, sure, we are talking about performance, and it's about to make money for clients who invest in the strategy, or it's about making more money for your own trading. But, and this is the thing, what our target, in fact, is with this basket strategy here, it's to make sure that we have solid equity growth. So we're trading with a positive expected value and expect to turn a profit after a series of trades. Nevertheless, our main target is, in fact, to have a very smooth equity curve, equity line, which means we are not very, we're not seeing big drawdowns at all. And this is something especially institutional investors look for. So let's assume there's someone who invests 10 million in your account, and you tell them, hey, by the way, from time to time, I have drawdowns of something like 30%. I mean, on the other hand, we have to say something, trading approach with 30% drawdown has also some bigger potential on the upside, and you can easily probably double the account. But nevertheless, the thing is, if you tell someone who invests 10 million in your account here, and wants his money seen being professionally managed, and you drop something like 3 million, I mean, I'm talking for a reason in absolute amounts here, because that's better to grasp the concept behind this. Well, then obviously he probably will say 30%. Well, you might be a good trader, but sorry, I'm not interested. That's something completely different if you tell him, hey, the overall max drawdown we have to face here over a time span of something like, let's say, a year, 2 years. We traded the strategies for quite a while now. The return table here shows you exactly that. Well, and you tell him, hey, the max drawdown was 5%. He might be fine with that. You say, well, this is really great because the drawdowns are only 5%, and I can expect, based on the history, let's say, a return of something like 10%. So just to throw in some numbers here. And this is a good risk-reward ratio for the investor itself. And why do I say all this? Well, the main reason is to make sure that you start to think about your trading in exactly that way. So if you want, as a retail trader, trading your own account, you are your own investor. And just wonder, if you were investing in yourself and then seeing some swings, some equity swings of something like, I don't know, 80% up and down swings in your overall equity line, would you invest in yourself in this moment? Or would you say probably it's better to have someone who has a better understanding of taking risks, let's say? And this is exactly where professional trading kicks in, and to get a better overview of what professional trading in fact is, and what profitability in trading in fact means. So let me just, by the way, have a look here. Okay. Okay. Let's now switch back to the S&P here. So some of you might wonder, hey, it's a live trading event. What about the live trades? This is another great thing about having a clear plan and clean parameters you follow each day. So in fact, I'd really like to give you some trading action here, but in fact, the only trading action I can give you right here is the one happening in the account so far. So meaning what you can see here is plenty of open positions. Currently, it's a profit of something like 500 euros. That might not seem that much if you consider the fact that we're trading 400 grand here. But the thing is that we already scored some profits. So I've obviously taken some profits here in the DAX. And on top of that, and that's the main reason, well, we have a strategy which needs another 25 minutes to define our open range, which means we have to wait till, in our case today, 2:15 p.m. GMT, until we have the range, and then we position ourselves based on the breakout on the open range, out of the open range on the up or on the downside. In fact, by the way, it could happen that we're trading the long side. So I might be skeptical right now about trading the long side based on the price action from yesterday, the overall reaction to this dovish hike from the Fed, plus on top of that, the bearish performance the European equity markets have shown us so far. But now the thing is, if we are stabilizing here and we are then breaking out of the open range, which was defined, and are trading above this yellow line, the exponential moving average 10, we're trading the long side. Okay, so this is in fact the case then that we're just saying, well, we say we define the open range, and if we're trading above the exponential moving average 10 on a 50-minute time frame, well, we are going long. The only thing I'd like to add then from a discretionary perspective is that I'd say, well, probably it makes sense to reduce the position size a little, since the overall advantage after the overall performance from yesterday evening till today till today afternoon is on the short side, and we're trading significantly below the lows from yesterday. So this is a so-called true gap. So we are trading below the lows from yesterday, and this gap which occurs here, some might say it's likely that it will be closed. Yes, probably. But the thing is that we are currently need a push of 25 points on the upside. And so far, it doesn't look that promising. If you now go to the 1 hour chart, for example, what you can clearly see is that, first of all, there is a clear structure of falling highs and falling lows building. And even if we find support here at this level, I think there's a good and realistic chance that there will be probably another more aggressive push here at this potential trend support, holding this overall consolidation area after the crash here at the beginning of February in play. So if we fall below that level, I think there will be further losses of another, in this case, 1 to 1.5, 2% probably, bringing us to 2,650 points in the S&P. And this could, in fact, be a deep red trading day then for the S&P, and probably something to worry about. And that's one of the reasons why I reduced the position size if I have to enter the long side, but probably go for an even more aggressive approach and probably increase the risk slightly. Let's say I'm risking usually 1%, probably increase the risk to 1.2, 1.3% probably, to make sure that if such a break occurs and the market, in this case the S&P, really slides on the downside, that I then can even make and turn a bigger profit on this trade and make my average gain bigger. Again, why is this important? Have a look here at this ratio again. Okay, this is the payoff ratio, and it's all about the expected value. Make the average gain bigger, then you probably will turn out in the long run. If you can stabilize this in the long run, you can expect to make a bigger profit in your overall trading. And this is exactly what you want to make sure. In fact, there's a belief in myself and during my years as a trader. In fact, my first target is to make this average profit bigger, since this makes sure that I stay alive longer in trading. What do I mean by that? Well, there's always some kind of risk of ruin or reaching the point of ruin in your trading. You can make it as small as possible, and it might look at first glance if it's zero. Nevertheless, in 1 out of a billion, trillion, quadrillion years, there's a chance that you probably reach this point of ruin. It's highly unlikely. Nevertheless, what I aim on in my trading is to increase this expected value and make the average gain bigger while reducing the average loss, with the main target, in fact, to increase the overall payoff ratio, since this reduces massively the chance of going broke with my trading and makes it possible, or no, adds further room for me to be on the wrong side the next, I don't know how many trades. And that's something I firmly believe in. And so far it turns out really well, because the great thing is, there's a saying in trading, if you take care of your losses, the winners will take care of themselves. And this is in fact how it is. Yeah. Okay. Yeah, that's it from my end. And this is very, very nice feedback from Mr. Hyren, that he says that that he's thankful that I'm sharing my valuable knowledge. Much appreciated. Thank you. Yeah, if you have any further questions, please just let me know in the chat box. Else, I probably say that's it from my end, at least for now. Again, so in around 3.5 to 4 hours, no, it's 4 hours, in fact, it's 6 p.m. GMT. There will be this special webinar together with Stefan, and I'm really looking forward to it. I hope that many of you guys register and follow our thoughts here. And yeah, so in fact, that's it from my end. I wish you all the best. Happy trading. Lots of points and pips. And we talk again to each other next week then on Thursday, the 29th of March. I have to say right now that I doubt somehow that there will be lots of actions because of the Easter weekend then. And usually what you can see before Easter is that liquidity, that your liquidity that the liquidity is thinning out. And probably volatility is drying out too. So probably there's not many big moves to be expected next week then. But let's hope the best then. What is the preferred time to trade? That's very interesting, because in fact, it differs from market to market. But when looking at the DAX, which is my main traded asset here, what you can usually see is that the main price action, yes, the link to the webinar you're asking is above you. It's a poster from FX Street. You can see this. You can check this. So it's the GoToWebinar registration link slightly above your post here. But back to the preferred trading time of mine. So in the DAX, usually the main trading time can be found between 8 and 9 a.m. GMT. So which is around the first hours of trading. And so this is in fact the main window I look at, even though things have changed a little. And over the last months to year, I would say, there's a clear drift towards the main action also in European equity markets than during US equities. Well, probably it makes more sense to say it's the last months. And this is due to the fact that the volatility here came in, especially then at the beginning of February, and bigger moves came in the afternoon. And this now makes the impression, at least, that the DAX is moving during those times. But I think it's only a time, it's a time period now during this, during which we can see bigger moves here. Usually it's at the first, similar to the US market opening, it's in the first hour, probably first 2 hours of trading, that you can see the market making a decision whether it wants to go on the long or upside, if it's a trending day, and then just moving in this direction. And many breakout systems, in fact, open range breakout system and all this, are aiming at exactly this window here. FX strategies, yes, as already mentioned at the beginning. So there will be a PDF, an ebook sent out to all those who are interested on the Euro-Japanese yen. It's a breakout system. It works out really well, beautiful today. And this is an FX system, but you can also see here, it's the symbols which are traded. As you can see, there are many currencies obviously traded, not only the indices and gold, but also many currencies. So yes, there's also several strategies which are trading the FX markets. Okay, that's it from mine. Happy trading. Watch your stops. Take care. Talk to you again next week or already in the evening. I definitely look forward to it. And have a nice day. See you. Take care and bye-bye.